Hi, good morning, good afternoon, and good evening, and welcome everyone to the 2023 edition of the Mayar Capital annual meeting. I'm Marc Cox, Mayar Capital's Head of Investor Relations, and we're delighted to have you all here, and we look forward to an engaging and interesting conversation over the next hour or so. Those of you who have dialed into previous online annual meetings will notice a few tweaks to the format as we progress. We've made these changes to be able to introduce more interactive features to proceedings as we look to direct discussions to the topics that interest you the most. The first of these are live surveys. You can participate by visiting www.menti.com and entering the code that's on your screen there, 77361766. And so let's test this out. Let's start with the first survey question. Please go to that link and enter the code displayed on the screen, and you will then be able to access the first question. To kick things off, we're asking you, what do you feel most positive about when you look at the market environment? Type in a word or two into the answer box and we'll see the anonymous answers over a few minutes. And we can see people are dialing in. Excellent. Thank you for that. We can see some of the results on the screen now. We want to create an interactive environment for everyone, so we have a live questions feature. So please don't hesitate to use this at any point. You can simply type that you would like to ask a question into Zoom, and the control room will either send it through via voice if you prefer, or by text. We appreciate your input, so please don't be shy. And if there are any topics that we haven't covered, or if there's something you would like to know more about, there will be a dedicated Q&A session towards the end of our meeting today. So without further ado, it gives me great pleasure to introduce our Mayar Capital panel. First, we have Aziz Alnaim, our Managing Director and Portfolio Manager, and joining him is Aubrey Brockerbank, Head of Research. Thank you for joining us both.
Didn't really have a choice.
Well, first, let's take a look at some of those. Take a look at some of those survey results. If we could see on the screen, there should be a word cloud there with some of the topics that people are most positive about when it comes to looking at the investment environment as we go forwards. I think we saw inflation, Japan in there as well, interest rates, and that may come as a surprise to some of the people. We can see rates, inflation, productivity, Brexit. People are positive about Brexit. Wow, that is a surprise. We'll come on to that in a second. But I guess the big surprise is inflation and rates, given the fact that's probably have been a concern over the last 12 to 18 months.
Yeah, I mean, I obviously can't speak for the person who put it in, but I suppose inflation coming down, even though in the UK it's been a bit slower than other places, but in many places inflation has come down. So I guess on a differential basis, it's a positive.
And I guess the same with rates. They're kind of interlinked, right?
Well, I guess it depends if you're a saver or a borrower, right? If you're a saver, I mean, and a lot of people are, they've been getting nothing on their savings, and now you put your savings in the bank and get a decent rate on your savings. So I guess if you're a saver, having 4 or 5% on your money is not too bad.
And I guess if we look at Brexit, if we're talking about that in our office, that might be the optimism that it will be reversed.
Well, I wish that were the case, but I think if we're going to be realistic, hopefully if we get a new Labour government in the not too distant future, they may be able to do things such as perhaps take us back into the common market, maybe under a different name, but we may be able to start trading with Europe properly again and see things revert back to normal.
Okay, well, it's good to see that the technology is working. There'll be a few more questions that we'll be asking you as we progress, but the customary first step is to talk about performance, and there's no change here. What has changed, though, is that we're showing performance over rolling 5-year periods. You should be able to see that on the screen in a moment. So, Aziz, why the change?
Well, I think it might be a change in how we present it in the annual meeting, but it's not a change about how we think about it. We've always talked about having a longer investment horizon and only investing with at least a 5-year eye in terms of when you need the money, basically. So I don't think there's a change there. One thing that's interesting is recently you'd have seen that our 5-year performance has dipped a bit. And one could argue, well, it's a 5-year period. Why aren't you doing so well over 5 years? You've always done well over 5 years. And I think what you can see from this chart is that the biggest driver of that underperformance is only basically in the past 18 months. So the period of underperformance is essentially the past 18 months. But depending on how you pick your starting point and your ending point, the numbers would look differently. And so in general, looking at performance on a rolling basis has that benefit of not being tied to a single starting point and a single ending point, which could really skew the results massively, even over a 5-year horizon. So it's always better to look at returns, whether a fund or a stock or anything on a rolling basis, I think.
Okay. Next up, we have some contributors to performance over that same 5-year period. When the table comes up, I think we'll see that the best have been UPS, Richemont and Brenntag, and some of the detractors are Vistry and Mayar Homes. Both of those are home builders, and we might be hearing more about those a little bit later. But on the right-hand side here, we've gone back to 2018 and seen what the worst performers have been over that time, and we can see that there are two names that appear in the 5-year period. So maybe a few words on that. But before we get to that, we'll ask another question, which is, over what time period do you think an investor should wait until an investment starts to work? I think the answers you'll be able to see are 1 to 2 years, 2 to 3 years, or it's 1 to 2 years, 3 to 4 years, 5 years, or as long as it takes. While we're waiting for those answers, why don't we hear the story of why we've included that data point in the presentation?
Well, I think it's very important to remember that often when you make an investment, it doesn't necessarily work immediately after you purchase it. And anything kind of within, I think, the first year or two is essentially noise. I think there's a tendency as well for especially value investors to buy a bit too early with the benefit of hindsight. And so often after you buy something, the short-term issue that the company is dealing with is still ongoing, and patience is required for that to go away and for the long-term value to appear, which requires a lot of patience. And that's always been kind of one of our strengths, this ability to look beyond the immediate and look over the long term. And so I think it's not uncommon for our best performers to also not do well over a period of a year or two. There's just too much noise. And I think one thing that we wanted to show by showing these results is exactly that a patience is often rewarded, and then in the short term, if you're not if you don't go in with that expectation, you could get really frustrated and you might end up selling too soon.
Okay, let's if we could have a look at some of the answers that are coming through about what our audience think that the appropriate time period is. If we could see that. As long as it takes is there. I guess, given what you've said, as long as it takes could be one of the more sensible answers. As long as it takes. There you are. Well done there. That's either everybody or one person. I'm not sure which. So everyone thinks as long as it takes, which, you know, given what you've just said, is not an unreasonable answer, I guess. But is that the answer that you would have given?
No, I completely disagree. I didn't mean to trick people into answering the wrong way, but it's funny that it came out that way. No, I think you have to be... So in the beginning, basically, you have a lot of noise. If you think of the stock price as essentially driven by emotion and noise, on the fundamentals as more reflective of the realities of the business, then I think in the very short term, you should completely ignore the stock price. But as time goes by, two things happen. One is that you will get either confirming or disconfirming evidence of your thesis from a fundamental point of view. So your view on what's going to happen to revenues and margins and returns and all of that. And you should at some point kind of have enough data points to see whether actually it's working out fundamentally the same way that you envisioned. And then the other thing that I think happens is that as the market isn't completely dumb. The market can be inefficient at times, and it can be inefficient in rare cases. It's not inefficient all the time. And so as you move forward from the point of view of your purchase, the noise that is a function embedded into that stock price will reduce. And if over 5 years, for example, just to take an example of one of the answers, if over 5 years the stock hasn't gone anywhere or has gone down, the odds are you're probably wrong about your thesis. The important thing to do, I think, is to look at the fundamentals and how the fundamentals are unfolding. And then if the stock doesn't follow the fundamentals over, say, 3 years, you really need to have a very good reason why that isn't the case. And it could be an external shock to the market overall, for example, that's causing that point. If you bought a stock in 2017 and fundamentals have worked out fairly well and you're sitting in March 2020, well, the stock probably at that point isn't doing well, but there's a good reason why that's the case, and it requires more patience. But if you cannot come up with a convincing reason why that is the case, then you're probably missing something. And I don't know if Aubrey, you want to.
Well, this is why we review stocks every quarter. They release their numbers and we compare what they deliver to what we estimate. Now, we try not to get too influenced by the short-term noise, but at the same time, we have to check that they are on the right trajectory. And if they're not, that's when we start to have to ask questions. The longer they diverge from the trajectory we estimate, the more we have to question ourselves, to the point that, as you say, there comes a point where you just have to admit you're wrong, and we've done that in the past. It's not comfortable, but that's the job, right?
And then the other thing that we've talked about in the past is when we go in, we put a range of assumptions around every single kind of line on the P&L or the balance sheet that when we're building our models. And if something comes out that's completely outside those assumptions, then essentially we're wrong about the business. If we thought the business could never lose money, for example, in our assumptions, and then suddenly the business is losing money for 3 quarters in a row and we cannot explain why, then we're probably wrong. So it's also important to think of the original thesis, put it down in black and white, have it and review it all the time to make sure that you're not off your existing initial assumptions.
Okay. Well, let's dig down into some of the stocks that we saw in the performance table there. Let's talk about UPS first. And most of us were confined to our sofas for a few years ago, and probably use UPS to deliver goods to us. But for those of you unfamiliar with the distinctive uniforms, then take a look at this video to acquaint yourself with UPS. So let's talk about the thesis going into it. What was the story at the beginning?
Well, I mean, like you said, a lot of people know UPS, and probably everyone knows the service that they provide, whether themselves or others. But the idea of ordering something online and a package magically appearing in front of our door has become more of a norm, to the point now that when it doesn't work, it's only when it doesn't work that we're surprised. But if you think about it, there's a lot of magic that happens behind for that to really function, especially as quickly and as efficiently. The idea with UPS is you do have a business where it is impossible, in my opinion, or virtually impossible for a newcomer to come in and scale up. It reminds me actually of something that there are a lot of businesses like that where you might have an easy barrier to entry at a very low level, but it's pretty incredibly difficult to come and compete with them. And the only person who's ever been able to kind of build this up in the recent memory is Amazon, and Amazon already came in with this scale. But essentially, you've got UPS, you've got FedEx, you've got DHL, and then you've got a few smaller competitors that are more regional or at a country level. And the idea is basically, not a lot of people have the balance sheet and time to replicate this, because it takes a lot of time to build it. It takes a lot of expertise. And so this is a very safe business. It's a business where there are high barriers to entry. And this is a business where at the time that we purchased it, we thought that there is nothing fundamentally broken with it. And yet it was trading at levels where the market was implying that it is. And that was driven by essentially 3 things. The first thing that the market was worried about is Amazon's entry into the delivery business. And our view was that there is just so much volume coming from Amazon and others that even if Amazon entered the business, it wasn't going to completely take away so much volume that UPS cannot survive. We also believe that Amazon's volume wasn't particularly profitable anyway. The other thing is that at the time they had the big pension deficit that was worrying a lot of people. We believe that, I mean, not we believe, we knew that that was mostly driven by a low interest rate environment. And we believe that once rates reverted, that accounting deficit would be corrected. And then the third thing that people were worried about is essentially this idea that the whole online thing is already done and penetration is high, which we know not to be true, but that was the view. And so you've got this cash generative safe business that has the ability to invest, and not a lot of people can come and compete with it. And you can really kind of look forward many years and see that. So that it was facing a short-term perception challenge. It was facing a short-term accounting challenge. And we believe that with the arrival of new management at the time, not only are the two challenges going to be overcome, but we believe that there is more upside from better efficiency, better margins, and a better approach to managing the business. And that's what has unfolded so far.
And so we often talk about buying great companies that run great businesses. The third part we look for is that great valuation. So what prompted the decision to buy?
Aubrey, you want to take that?
Well, for the year previous to owning it, it pretty much gone nowhere, and the same as FedEx. So we, yet earnings kept growing, sales kept growing, and these worries kept persisting. And one of the things that's quite nice is when you start hearing people getting really worried about a business, that's often a really good time to start looking at it, because that's when the valuation is going down, but becoming more attractive. And if they're wrong, then that's your opportunity. So I think it was at about a 6% free cash flow yield, which is really pretty attractive, and for a great business. And we then looked at compared to FedEx. I think it was at about the same valuation as FedEx, but we just prefer UPS. It's got much better efficiency, further package to the more of the document delivery. It seems to have more pricing power, and it doesn't have the big fleet that airlines, well, not airlines, but aircraft that FedEx does. So it seems more attractive, and a year later it was sort of roughly where it was, but then the airlines it just took off.
Very good. Yeah. Well, I was going to ask you about that. I mean, that seems to be a well thought out thesis. What actually happened once you bought it, and why do you still like it?
Well, I think shortly after we purchased it, they missed their earnings and the stock tanked. So back to what I said earlier about buying it too early. It was a temporary hiccup, and it was, in many ways, it wasn't a fundamentally negative outcome if you view things through a longer-term lens. I mean, no business is going to be smooth sailing all the time. We're going to have some quarters that are tough, and I think Wall Street often overreacts. But I think when that happens at the same time that people are already worried about the business, and the market can really overreact negatively in the short term. That being said, since we purchased it 5 years, I think it's more than doubled. So the investment has done well over time for us, even though in the beginning I think it went a bit nowhere. There was a little hiccup along the way, but you own something long enough, you're going to have quarters where the stock is down a lot, and you do things long enough and you get used to it eventually, I think.
And it's still a position in the portfolio, correct?
Yeah, it's still, I think that's in any one day, but it's definitely one of our top 5. We still think the growth picture has not changed. I think there's a lot of opportunity that's ongoing in terms of automation, in terms of whether it's how you run distribution centers or even how you run your fleet and routes. I think UPS is a big beneficiary of AI and other technologies. And so there's just a lot more room for this to run as a business for years to come, I think.
Okay. Well, thank you for that deep dive into UPS. We're going to move on now to another stock. I'm not going to tell you what it is exactly because we are going to have another question now, and there are some features of this stock that we're going to read out, and then hopefully you'll be able to tell us what it is. So, Aubrey, I think you have got a list of characteristics that you'd like to see if our audience can see which stock in our portfolio are we talking about.
Okay. So they sell an essential product. They have high returns on capital of about 30%. They've had consistent margins of between 10 and 20% over the last 10 years. They managed to even produce net profits throughout the great financial crash. They doubled their operating profit in the last 5 years, and they're guiding again to almost double their profit over the next 5 years. They have a net cash position and benefit from a really good supply and demand situation.
Right, so we can see some results on the screen there. And before we reveal the answer, let's give another clue. So for those still wondering what the answer is, here's possible future Prime Minister of the UK, Keir Starmer, setting out his vision for UK housing policy.
Make sure that many, many more houses are built and that the price comes down, because of course what we want is good quality secure houses, but also houses that people can afford. There's nothing like the security of having your own house.
So there we saw Starmer addressing one of the policy issues that beset the UK particularly, and with all those clues, congratulations to the 33% of people that said Vistry. That's what we're talking about here, and those comments seem to suggest that there's some policy support for house building, home building generally in the UK. Was that the thesis and part of it when you first looked at the stock?
I mean, it was certainly supportive of the thesis, but that wasn't the whole thesis. I mean, but let's just talk about how supportive it is, because even our current government have committed to building 300,000 houses a year. Now, they've missed it this year, and they'll probably miss it again. But on average, we tend to build about 200,000 houses a year in this country. So this is just such a big uplift, and it's because the demand for 300,000 houses is there. People are clamouring for it. We just need to build supply. So, when the government sort of does this, they're doing it with funding, they're doing it with local partnerships, local councils, and they're also doing it for some of the more affordable houses. And this is one of the reasons that we chose Vistry as opposed to, let's say, Berkeley. Berkeley, I mean, it's a great house builder, but they build sort of £1 million plus houses, central London and apartments, and it's fantastic. But Vistry is sort of at the 300k level. They work with half their business almost. Or at least it will be, is with the local councils, and it's their partnership business. And so this is going to be far more protected in downturns. It's going to be far more protected because you've got all this support coming through, and it has to come through, whether it's from a Conservative government, a Labour government. Both parties are committed to it because they have to. And there are going to be difficult times. But, certainly at the moment with interest rates, but we'll discuss that in a second. But ultimately, when you have a situation where the supply-demand imbalance is so great, you know that eventually it has to resolve itself. And Vistry are absolutely there, positioned to capture that. But, that wasn't the whole thesis. As we said, I'm quite pleased that people sort of guessed Brenntag and Unilever, because when you describe a business with 30% returns on capital, consistent doubling growth, you do not think of a home builder. You think of something sort of maybe a bit more asset light, something fast moving consumer goods or specialty chemical distribution. You don't necessarily think of a home builder, but that's what they actually are able to achieve, because it's actually a really difficult business. It seems easy, you just build a house, right? But the planning that goes through, they have to, negotiate, sourcing the land. If you want to compete with them, how are you going to? It takes 5 years to get planning permission, sort of almost minimum. If you're going to try and acquire a big site, get the permission, get the architects, get everything else, it takes an awful long time. So a lot of people, if you're going to try and scale, as you were saying before, you might be able to build 1 or 2 houses, sure. But if you want to build at scale,
you're not going to have the margins of the big builder anyway.
No, you're going to go bust before you ever get there. So we can see the moat, we can see all these great things about it, and at the same time it trades at this big discount. And then we can look forward and we can say, okay, the company's guiding for 30% return on capital going forward. They're doubling their margins, and we can see, okay, if they have that off 800 mil, they need 2.6 bill of capital. So that's an additional 900 mil of capital they need, okay, minus the cash. Well, they're making 400 mil of cash flow. So, okay, they can actually do this, in a very short space of time. They can achieve these aims. And we can just sort of mechanistically work through all these numbers and say, okay, it's achievable, it's possible, and it's going to deliver returns for us.
And it's dirt cheap.
Yeah.
Well, I was going to
If they do double it, 3 times earnings, less than book value, and home builders rarely trade at less than book value.
And are they the characteristics that prompted you to buy? I mean, we can see why that would attract you and the team to investigate and analyse the stock, but ultimately you've got to pick an entry point. What exactly was the catalyst for that?
So in this case, in general, price is always a good catalyst, but it's sort of a necessary but insufficient condition. And we purchased Vistry during the depth of the pandemic. And one of the things that we realized at the time was, well, certainly I hadn't until that point thought of a situation where you can have a business that's ongoing and then for a while you have zero revenue because the government has forced you to completely shut down. It wasn't in the business books, right? But then what we realized with some businesses, Vistry and the other home builders, one of them, they're businesses that we followed for a while, is that they can really kind of almost mothball the whole organization. And their cash burn at the bottom of COVID was so small, it gave us this kind of hint about the resiliency of this type of business, their ability from a cash flow perspective, which is something that I guess we hadn't appreciated as much until that point. And then the other thing that we realized at the time was that obviously it was very cheap. And so the downside was fairly protected in the sense that no matter where we kind of assumed in terms of land values over time, this is a business that was trading at valuations where it's worth more dead than alive. And so we knew that our downside is protected. We knew that it can generate high returns in the good years because we've seen that in the past. The one thing we didn't know is how long it would take for COVID to resolve, or in today's environment, how long you're going to have a difficult environment. So the timing was a question, but the ability to generate returns over time was absolutely not in question. And we sort of like these types of investments where your downside is protected, you have very clear upside, and the only uncertainty is the timing.
And so we saw Vistry earlier in the detractors from performance. So are we saying it's too early to tell whether the thesis is playing out? Is this a case
I think
where
it's
patience is required?
Definitely. No doubt patience is required. Obviously, it worked out well initially, and we sold some, and then we bought some more later on. But, I mean, the interest rate environment that we hear has caused a slowdown in housing in the UK. But one of the great things about the way the mortgages work in the UK is people are not locked into a 30-year mortgage that with a guaranteed rate as they are in the US. And so at some point, mortgages are going to reset, whether it's 2 years or 5 years, depending on your mortgage. So on an average basis, you're going to have mortgage resets, which means that at some point, people are going to start moving and you're going to have kind of transactions come back. And once that happens, home builders benefit from the situation.
Okay. Well, we're going to move from UK now on to continental Europe and Richemont, which you may well be a customer of Richemont without realising it because it's owner of a number of luxury brands. And we have another video ready to go to show some of those products and luxury goods being manufactured and crafted. We also have another question which is related to this stock, which is what does Tom Cruise, Donald Trump and Napoleon all have in common? So if you could try and answer that, please keep it clean, and we'll see the answers after we see the video. So I'm not sure if you have a Richemont watch. Those that did include Tom Cruise, Donald Trump, and Napoleon, customers as they are. We've got 6 answers. Can we see the answers? See how many... Well, I can see some answers there that are probably correct, but not the one that we have on the card in front of us, which is that they were all consumers of Vacheron Constantin. We could have had any number of famous people there, ranging from Pope Pius XI.
Very pious.
We could have Harry Truman, and I think we were talking earlier. There was a person closer to home that was also a customer.
There is. It's really funny. So Ahmed Zaki Yamani, who was the former oil minister of Saudi in the 70s and one of the founders of OPEC, was very fond of the brand. He was so fond of the brand that he actually ended up buying the company. And I don't think he fully owned the whole thing, but I think he owned a controlling stake. And actually, Richemont bought it from him at some point later. I think it was in the late 80s or early 90s. So it's a fascinating brand. It's the world's oldest watch brand. Do you remember which year it was founded?
1730 something, 1735. Old
Sometime
enough that Napoleon could.
Yeah, well, exactly. Yeah. So it's and this is one of the things that we like about Richemont is that you cannot replicate that. The heritage of a brand is something that requires a lot of time, and you just cannot do that. You can create amazing watches today, but you cannot replicate the heritage that comes with specific brands.
Well, this is a position that's been in the portfolio for some time, not quite since Napoleon owned that watch, but that is a long-term position. And so what was the thesis going into buying that?
Well, I think I alluded to one of them. So I think this is a company that owns brands such as Cartier, Van Cleef, owns a lot of watch brands and other luxury goods. And you can say this about a lot of luxury conglomerates, to be fair. What's special about these companies is that they own brands that not only deliver high-quality products, but the brands themselves are essentially irreplaceable. Luxury comes, I think Chanel said something like, luxury starts where necessity ends. And essentially, no one actually needs a luxury brand. They want a luxury brand. And because it's a want, and because it speaks to you on some level that is not practical and pragmatic or utilitarian, but instead on some emotional level, things like the heritage that comes from a brand, the history of their brand, where time really makes a big difference, become extremely important. And because you cannot start a 100-year-old company tomorrow, it makes it virtually impossible to compete with these brands. So that's one of the things that we like. And what this brand strength gives you is several things. One, it gives you tremendous pricing power. And so you are not at risk of your costs running ahead of your revenues. Your ability to price well ahead of that is fairly strong. And if anything, sometimes the higher price makes your brand even more valuable, and people want to buy it even more. So that's kind of one big part of it. This translates into higher returns on capital and translates into really attractive cash flow yields, which you can then reinvest into supporting marketing and essentially widening that brand moat that comes with the business. The other thing with Richemont that we liked specifically is Richemont, different to other luxury conglomerates, Richemont is very heavy in jewelry. So they have the watches, they do have the soft goods, but their jewelry maisons are a big part of the business, led by Cartier especially. And one of the things that we like about jewelry is that essentially the purchase decision is not necessarily voluntary often. There are so many events in a person's year where they have to go out and buy a luxury good. They have to specifically buy jewelry. And whether it's because there's a date in the calendar or the poor guy has made a mistake and he needs to atone for his sins, but you have to buy that thing. So from the point of view of the purchase, it is beyond a discretionary purchase. It's a need. And then the other thing that comes with it is that we've observed this over time, is the part of the jewelry market that's branded is still small, but it's a growing component. And this is where people like Cartier and Van Cleef really can come in and capture essentially market share from that unbranded jewelry business. And then the last thing that we like about it is you do have a tailwind that has happened and will continue to happen for many years to come from the whole world becoming wealthier. And one of the things that people do when they're wealthier is they no longer need to spend X% of their money on essentials, and they have that discretionary income that they can spend on things like jewelry and watches and luxury. So those are the things that we liked, and it's led by an excellent capital allocator, and that was definitely kind of the cherry on top.
I wanted to ask a broader question that Richemont reflects, which is when you have a stock in the portfolio for a long time, is that one continuous investment thesis? Is it a series of shorter term investment theses that change? And if it does change, how do you guard against thesis drift, the gradually changing the story to fit the circumstances rather than making an analytical decision?
Well, no, you can't quite describe it as one long holding, because, as you say, things do change. Valuation changes, for one. If a stock, performs really well, you may well sell, and then, when it comes back down, you might buy more. But you don't necessarily sell out. You might just reduce your position, because we'll reduce our position as the valuation increases, and we increase, as the position decreases. So that's one thing. But also, things change. With Richemont, one of the things that happened was that they bought Net-a-Porter. And when that happened, we were concerned. But it did seem like a good decision at the time. But we had to sort of spend a lot of time, a lot of work understanding what the business was. And also, we did realize, though, that even though it's an important decision, it was not a massive part of their business. But we still had to do a lot of work on that. And but sadly, that is one of the reasons that Richemont did not do very well, because, for a long time, this business was losing them about 250 million a year. Now, so we had to say, okay, is this essential to Richemont? I mean, we all know that online is essential, but it perhaps wasn't the right owner, because the problem with one brand or one house of brands owning that is that's going to upset a whole load of other brands. Net-a-Porter really needs to be owned by Switzerland, by someone neutral. But whilst the stock was not working, the one thing we were able to really sort of realize was either they're going to have to get rid of it or they're going to turn it around. And either way would make money. But we had to underwrite that decision then. And fortunately, as we've seen, they've now got rid of it. They've sold it to Farfetch. It's hopefully in the hands of a better owner, which will be good for the whole industry. And that has been reflected in the stock price.
And I think one thing to add there is there is something that may not show up in the number, which is Richemont learned things from the experience. Richemont's own online maisons websites have improved, and the whole experience of selling online, how to market online, has improved with the ownership. So while they did lose money on the books with that, it wasn't completely without benefit. And it's very hard to look at things after the fact, especially with business decisions, and say, well, that didn't work out. But you want businesses to take some risks, and sometimes it'll work out, and sometimes it won't. And that's the nature of business.
Okay, thank you for that. Before we get to our Q&A session at the end, we'd like to spend some time talking about Brenntag. Brenntag is probably one of the less well-known of the stocks that we've been discussing today. So let's set the scene of who they are and what they do in their own words.
Innovation and quality, passion and sustainability, 150 years of experience and a sense of what's next. We are Brenntag. We care for every aspect of daily life because we share the most comprehensive portfolio of chemical products, ingredients, knowledge, and services with our partners. We purchase our products from all suppliers in the industry. And we set the highest standards for quality and safety worldwide. We offer everything from essential products to individually tailored solutions and always the latest knowledge. Our two divisions, Brenntag Essentials and Brenntag Specialties.
So hopefully you will have got a better understanding of, maybe you're a consumer of Brenntag products without even realising it. I saw some ice cream there. Is that how you discovered Brenntag, or was
I
there?
think almost certainly everyone is a consumer of something that Brenntag touched at some point. I think it's very hard to avoid that.
No, I mean, we came across that just because I covered chemicals at my last firm, and one of the PMs pulled me aside and said, "Look, actually, I want you to do some work on this one because, I don't want to own something so cyclical." The trouble with most chemical firms is they are really cyclical. Their earnings are wild, and then, the share price can be even wilder. And Brenntag, they distribute basic chemicals and specialty, but you'd think, okay, that's going to, be as cyclical. Sadly, sometimes the share price is, well, not sadly.
I think it's a good thing.
Exactly. But the business is really, really very stable. The margins are just so stable. They pretty much grow every year. It's only in really terrible years that you see margin revenue declines, but that's usually pricing, not volumes. And the pricing is, a lot of that is passed through, so it doesn't necessarily affect the operating margin as much. So it really is this very resilient business. And, as you're saying, the volatility is a good thing because, when you have a stable business that's doing this and the share price is doing this, you can buy it here and sell it here, which, we have, done in the past. And
Well, I guess that disconnect between the volatility of a business and the volatility of a share price speaks to our process, but it's also a gift to investment managers.
Oh yeah, definitely.
absolutely.
Definitely. And to make a chemical joke, I mean, it's like a toll bridge.
Yeah.
No, definitely. I mean, whenever you have a stock that's more volatile in the business, this gives you a tremendous opportunity to buy low and sell high. I mean, that's a no-brainer, I think.
Yes. But at the same time, this is not a stock necessarily for trading. This is a really good investment because they have really good returns on capital, really good margins, and returns on capital like a home builder, you'd say. But also they're the market leader. They have a 5% market share. Now that doesn't sound a lot, but the top 12 have the top 6 have 12% between them. So they have almost as much as the rest of the top 12, combined, and that gives them a huge advantage. And again, another business, like you were saying, easy to set up. You can, the three of us could go and set up a chemical distribution business, and we might make a salary between us. But to actually scale it to this size, that's nigh on impossible because you need offices all around the world. You need logistics. You need the warehousing. You need the specialist care. Because in many ways, this is a bit like, this is to this is to, let's say, BASF what a pharmacy is to Walmart, or to whatever. A pharmacy does the actual specialist distribution of the medication, and it's more than just selling it. They're more than just a retailer. Actually, they package it. They get the dosing right. They also might mix formulations with certain antibiotics, for instance. And Brenntag does the same. They will. So there's a lot of complex value add that they give, but they have a fragmented market. They have a massive total addressable market as well. They have 12 billion out of 271, and that is something that they can continually keep going after, keep acquiring, because it's actually a really easy market to acquire in when you've got people who do have small businesses, like maybe the three of us earning one salary between us, that these are really easy businesses to acquire and then just integrate.
I mean, I remember when Aubrey told me about Brenntag, I'd come across small chemical distribution businesses, privately owned in Saudi and elsewhere. And I thought it was like there's no barrier to entry here. And then I'd heard from, I think it was L'Oreal's CEO, and he said there are some businesses such as beauty where there are no barriers to entry, but massive barriers to scale. And it hit me in the head that this is exactly what this type of business is. No barrier to entry at a low level, but good luck trying to scale it up.
We got a hint of the complexity of the business in the video. Is that complexity part of the economic moat? I mean, you've hinted at it already. I guess that's the answer.
Yeah, no doubt, no doubt.
Okay, well, thank you for that. We've gone into quite detail about 4 different stocks there. Now we move on to the open forum part of the session with our Q&A section. Remember to submit a question. You can do so via text, and the control room can put your voice through, so if you so wish, to us, and we'll address those questions. And I think we do have a question that has come in through voice.
No, please do. It makes it more fun than text.
Okay, well, that's if I'm right, we can hear that first question now.
Can you tell me what is the future of American stocks, considering the inflation and debt issues we are currently seeing in the US?
So, a question about US stocks there related to inflation and rates. And I guess if you look at our fact sheet, we do have an exposure to US stocks, but if you compare that to the benchmark and the range of possibilities, it's actually a lot lower in comparison to that. So maybe a few words about that.
Yeah, so I think our view, and it's been actually, to be fair, for a few years now, that we found fewer opportunities in the U.S. compared to other places in the world. It's not that we haven't found any opportunities. I mean, we've talked in the past about Bright Horizons, for example, which is a U.S. business that we acquired shares in not that long ago. But it's just on a relative basis, we've been able to find more outside the U.S. than in the U.S. That being said, it doesn't mean that we don't think the U.S. market over the long term is an attractive place to be. Yes, it's less than the benchmark. It's about half of our portfolio, but that's half of our portfolio in one country, right? So we still believe in the long-term potential of the U.S. We still like the U.S. market. At different times, we may find some opportunities in one geography, but not another. But we still like it long-term. In terms of the impact of inflation, I mean, the U.S. is actually one of the countries where inflation has come down the most. And it's probably kind of ahead of the curve compared to Europe and certainly the UK in that regard. So that's going to be positive to the US. It's going to be supportive of a lack of the need to continue to increase rates much higher, which probably will translate into higher growth in the short term. But now I'm kind of delving into macro forecasts, which is definitely outside my circle of competence.
Okay, thank you for that. We've got some more questions coming in. Are we going to see those on the screen, or will we be able to hear them? When do you expect the IPO window to come back with more activity? Actually, we had a question about this at the recent FT Alphaville quiz, which was how many IPOs had there been over... to give you some idea of the quizzes that Aubrey and I attend. But
One-off. We guess 5. There's only been 4.
Yeah, and so I think this question speaks to a relative dearth of IPOs in 2023. Well, I guess, first of all, is that something we're particularly interested in, IPOs? And what does it say about the broader market, do you think?
Well, I think there's 2 things at play here. One is that you're comparing the current environment to an environment where there are a lot of shitty IPOs that shouldn't have gone public. I mean, we just had one of our company, J&J, IPO, its consumer product company, and that was an extremely successful IPO. We own another company, LabCorp, that's going to also IPO its drug testing business. And so I think if you've got a good business, good fundamentals, I don't think there's necessarily a difficulty now in IPOing your business, at least over the balance of the year. But I think often throughout the business cycles, at peaks, which is what everyone is comparing to, you just have a lot of IPOs that shouldn't have IPO'd. But I don't know how. These things do tend to go in cycles, and the market overreacts on both ends, and I think we may have overreacted on the downside here. But I mean, luckily we don't own any investment banks, so that's not necessarily relevant to our portfolio.
Well, the market's going up, so there's a good chance. Also notice that Center Parcs is IPOing, or might be, which I'd be very excited by. That's I also know that there's a good chance it won't happen, but now I remember their old chairman telling me that throughout the depths of the great financial crisis, they still managed to keep utilization of 97%.
Yeah, certainly great business.
Yeah, but it's it's nice to have things like this that you can keep an eye out for. Yeah. But whether we buy that will, I doubt it'll come at a price that we can.
Not investment advice.
Okay, we've got a couple of more questions that have come in on the text. The first of which is, do ethical screens provide more or less opportunity for investment management? I guess we talk about the ethical owner method and framework that we use. Does that restrict us in any way?
Well, the first thing I'd like to say is please send us voice questions. It's good to hear from you, I think, and appreciate the format. For one, Marc went through and his team went through a lot of effort to make it possible that you ask questions over voice. So just
don't let daylight upon magic. This is all seamlessly
put
together, ad hoc.
So back to the question. I mean, any restriction that you add to anything is going to necessarily reduce the universe. Whether that's a good thing or a bad thing depends on how material the restriction is. I think if you have a global mandate like we do, and you add any kind of restriction like this one, I mean, it takes it up from tens of thousands to a few thousand names. I mean, it's not necessarily material from that sense, but I mean, mathematically, it does reduce the pond size that you're fishing in, but it's never been a restriction that is. It's not necessarily an issue that I think has ever impacted us. My view has always been that you should invest in a way that matches your personality, which also means that you should invest in a way that matches your ethical values. And I think when you do that for reasons that are non-economic. And so even if you operated in a market that is small, where applying ethical screens could materially hurt your outcome, I think in that environment I would do the same thing, but obviously that's a personal choice for everyone to do. In our case, I don't think it's ever been material to the point where I feel like we've missed out on something, and it just makes us sleep better at night. And I think over a long period of time, sleeping well at night is a valuable thing to target.
Yeah, I agree. We're coming towards the end of the session now, but we do still have time for a few more questions. We've got 2 text questions, and we do hope that somebody will also submit a voice question if you're not shy. The first of those text questions is, do you recommend that investors invest in ETFs as part of their portfolio?
I'm going to make an assumption about what the person who sent this question meant. I hope it's the right assumption. I am assuming that they mean passive index ETFs. And I think my view is it is a very reasonable thing to do. For most people, it's very reasonable to have a certain percentage of your money invested in passive ETFs under several conditions. The first condition I would add is you buy it and you don't touch it. I think if you're trying to trade in and out, that's a recipe to really do badly over time. The other thing is I would only go for very broad indices. So like an MSCI World or an S&P 500. I wouldn't go and buy a passive pharmaceutical ETF or anything like that. I think that way you're just trying to pick stocks by another name. And I don't think that you're going to necessarily do well. So if you're going to buy an MSCI World ETF and just stuck it away and add to it over the next 20 years, you're probably going to do very fine. And if it makes you sleep better because you don't have to worry about meeting managers like us and talking to us and all of that and then there's nothing wrong about it. I think it's a very reasonable thing to do. It's certainly much better for most people than trying to pick individual stocks.
Okay. Well, now we come to our final question. I think I know what you're going to say to this, but the question is, what are the top 3 ideas in the research pipeline?
Oh,
Is that something that you're willing to divulge?
Aubrey?
No.
Let me tell you the story. So, a doctor and a lawyer are in a party, and the doctor is talking to someone in the party. He's getting really annoyed, and that person walks away, and he turns to the lawyer and he says, "I'm really sick of this. Every time I'm at a party, someone walks up to me and they want to ask me some medical advice about this thing or that thing, and I'm just here to have a good time. I don't want to talk about work. I don't want to get into their medical situation." And the lawyer says, "Oh, I've got a perfect solution for you." And the doctor says, "What is it?" And he said, "Every time someone comes to me and asks me for advice at a party, I'll give them advice. And then the next day, I send them a bill in the mail. And you guess what? They never ask me again." And the doctor says, "That's a brilliant idea. Thank you so much for this. I really appreciate it." Anyway, doctor goes to the office next day, and there's a bill that has come through. The moral of the story is basically, this is what we do for a living, so we're definitely not going to give you our ideas. But in addition to our self-interest, it is not in the interest of our investors to share these ideas widely. In the end, even if it's a small probability that it might impact our investors, we're just not going to take the risk. It's why we don't like to talk widely about what we are buying, or not. That's why we don't talk about what we're buying, what we're selling. But also, we don't like to talk widely about what we own anyway, beyond very specific situations where we know all of our investors are there. And so there's an element of fairness there, but there's an element of protecting our investors and not talking about these things. Aubrey?
I think there's also a psychological element.
Yeah.
Like we have quite controlled, settings when we discuss new ideas. Where we're sort of challenging each other, where we're debating, but where we are free to be wrong. Mm. And we know that. The trouble is when you start pitching ideas externally, you start to try and justify it. You start to perhaps believe it when you haven't actually done all the work yet. And so it can lead you to some sort of, it can just lead you to bias. So it's, best to,
Yeah, I remember actually many years ago, I met a potential investor and he asked me about a holding in the portfolio. And I said I wanted to get this investor to invest in my fund. So I sat there basically pitching the stock to him in a sense, trying to convince him that I was right. And a couple of months after that, I completely changed my opinion about the stock. I thought I needed to sell it. And I remember feeling uncomfortable because he had already decided to invest and feeling uncomfortable at the time. I sold it. I overcame that bias, but feeling uncomfortable thinking, if he only knew that I just sold the stock, that I'd convince him as a good investment. And from that point onward, I was just very careful about what to talk about. And because of just what Aubrey said, it's hard enough as it is without introducing more bias to the mix.
We have to be able to change our minds.
Yeah, definitely.
Okay, well, I think that brings us to the end of our allotted time. I'm going to hand over to Aziz in a second for some closing comments. But before I do, I just want to thank everyone for joining us this afternoon. Thanks for your contributions. If there are questions that we didn't get around to, we're happy to answer them offline via email, but we're also happy to answer them in person. And we'll be coming to Saudi Arabia on the 5th. For our roundtables. They'll be available on the 6th and 7th of June in Riyadh, on the 8th of June in Khobar. So if you'd like to attend those, please get in contact and we can reserve your spots and perhaps we can answer some of those questions and more face to face. And we really look forward to that. One of the things that we do is consider the obligation that you put on us to look after your capital. We take that very personally. The pandemic sort of broke the chain of having these events in person, so we do have them online, but of course nothing beats that in-person interaction. So we really look forward to seeing you there, and we look forward to you reserving your spot. So it leaves me to say thank you once again, and then hand over to Aziz for some closing comments.
Well, thanks, Mark. I want to thank Mark and Isabel and Sophie for everything they do for our partners and for arranging this meeting. I want to thank you for attending today, and please do send us feedback about the new format. I think after last year we got a lot of feedback from you, and we tried a different format based on that, but we're always trying to learn to be able to kind of do things in a way that serves your need better, makes it a much more enjoyable and informative experience. Thank you so much for today, and hope to see you in Saudi in about 10 days' time.
Great. Well, that's all for now. Thank you very much. Goodbye.